Hey there, future CPAs. If you're a BS accountancy student currently pulling your hair out over the Philippine tax code, take a deep breath. You're in exactly the right place. Today's explainer is custom built for you. Look, we need to completely stop relying on that short-term cramming and memorization for the LECPA. Instead, we're going to build a rock-solid 3-year retention mental schema for Quiz 10. We're talking special transactions, documentary stamp tax, or DST, and those tricky tax penalties.
Because here is the absolute biggest trap accountancy students fall into. How on earth do you memorize tax rates today so you can actually pass the board exams 3 years from now? Honestly, if you just blindly memorize numbers off a page, I guarantee you're going to forget them by next week. The real cheat code for your brain is understanding the underlying logic and patterns of the tax code. Seriously, when you know exactly why a tax exists, the numbers just naturally click right into place.
All right, let's dive right into this blueprint. We've got 5 key areas on the agenda today. Number 1, DST on shares. 2, DST on debt and realty. 3, the penalty patterns. 4, interest reliefs. And 5, forms and deadlines.
Kicking things off with Section 1, DST on corporate shares, the equity pattern. So, try to think of DST not just as a tax on a physical piece of paper, right? It's essentially an excise tax on the privilege of executing the transaction itself. With that in mind, I need you to lock this massive number into your visual memory right now. 75% of 1%. In the Philippine setup, the DST rate for the original issuance of shares with par value is 75% of 1% of that par value. This is your anchor number for equity transactions. Literally burn it into your mind.
Now, what's super interesting here is the pattern that emerges. We've got our anchor, that's 75% of 1% for original issue with par value. But look at the no par shares. Notice how they're brilliantly hacked into your memory? The rate is exactly 50% of the standard DST paid on the original issue. Boom, easy. Then for stock dividends, it's just a flat 2 pesos on the actual value per share. And for the sale or transfer of shares, 1 peso and 50 centavos for every 200 pesos of par value. See how grouping them like this builds a mental framework instead of just random numbers?
Moving right along to Section 2, DST on debt and realty, the borrowing and buying pattern. Shifting gears from equity to debt, notice the stark contrast here. When a corporation borrows money, like a debt instrument, they get hit with a percentage-based tax, which is 75% of 1% of the issue price or face value. And if it's for less than a year, it's just prorated. But think about everyday bank checks and drafts. They get a flat 3 peso rate per piece. Doesn't matter if you're writing a check for 100 pesos or 1,000,000 pesos, it's still 3 pesos. Why? Well, so daily commerce and business don't just grind to a screeching halt under heavy percentage taxes.
Now, for real property, we have the ultimate LECPA trap, the tax base. Examiners absolutely love to trick you here. You must, and I mean always, compare the actual consideration against the fair market value, which is either the zonal or assessor's value, and you tax the highest number. Never, ever just look at the selling price. Once you've got that highest base, the DST rate is 15 pesos for the first 1,000 pesos, and then 15 pesos for every 1,000 pesos in excess of that.
All right, on to Section 3, surcharges, the penalty patterns. We are now entering the additions to tax territory. Honestly, this is where unprepared students usually panic and just start guessing. Normally, if you file late or pay late, the government slaps you with a 25% surcharge. But before I give away the answer, actively recall the difference between simply forgetting to file a return on time and, actively trying to cheat the government. What do you think triggers a massive 50% surcharge? So, the absolutely crucial point here is that the 50% surcharge is reserved for intentional bad behavior. It applies to willful neglect, which means knowing you have to file and just purposely ignoring it, or prima facie fraud. And how exactly does the BIR define fraud? It's anchored firmly by a 30% threshold. If you underdeclare your income by more than 30% or overstate your deductions by more than 30%, the law basically presumes you're committing fraud. And boom, that brings down that heavy 50% penalty. Now check out this super important recent update to the tax laws. This brilliantly illustrates the government's relief structure for smaller businesses. While regular taxpayers suffer that standard 25% surcharge for late filing, micro and small taxpayers actually enjoy a reduced 10% surcharge for the exact same offense. LECPA examiners absolutely love testing this new 10% exception, so whatever you do, do not miss it. Next up is Section 4, Interest Rates and Reliefs, the Time Penalty.
Because let's be real, when you owe the government money, they act exactly like a bank, charging you interest for the time you hold on to their funds. Blast this number into your brain right now, 12%. The general statutory interest rate for unpaid taxes under the tax code is 12% per annum. And here is a fantastic little hack to remember it. It is exactly double the Banco Central ng Pilipinas, or BSP, legal interest rate, which is 6%. Just double 6 and you get 12.
Okay, I need you to pay really close attention to these two terms because knowing the technical difference between deficiency and delinquency is literally mandatory. Deficiency is the amount you're found to still owe after an audit or investigation reveals you underpaid. Delinquency, on the flip side, is simply missing a deadline, like failing to pay the tax due on the exact date fixed by law, or failing to pay an assessment notice on time. I promise you, confusing these two will cost you critical points on those situational board exam questions.
Continuing with that awesome theme of relief for smaller businesses, let's look at how interest and penalties apply to them. To lock in your attention here, just remember the 50% off rule for micro and small taxpayers. They get a 50% reduced interest rate, which effectively drops it from 12% down to 6% per annum. And for criminal violations that do not involve fraud, they also get a 50% reduced compromise penalty.
Finally, we've made it to Section 5, Filing Forms and Deadlines, the Timeline Hack. Let's wrap this up with compliance. Deadlines can turn into a massive mess of random dates if you just try to memorize them in a vacuum. The absolute best study hack here is mapping these deadlines onto a chronological timeline in your mind. Think about how this flows from short-term to long-term. On the 10th day after the month ends, you've got a quick turnaround for BIR Form 1601C. That's for withholding taxes on compensation from January to November. Moving out a bit, on the 25th day after a taxable quarter ends, percentage taxes are due. And zooming way, way out, you have a full 1 year after the date of death to file an estate tax return. Visualizing this flow is a game changer for preventing deadline confusion. But wait, beware of this classic board exam trap. While we literally just said the 1601C is due on the 10th for January through November, you always have to watch out for December withholding tax questions. For the month of December, the deadline gets uniquely extended to January 15th of the following year, or January 20th if you're using the EFPS system. Examiners are absolutely going to try to catch you sleeping on this exception. Okay, let's bring this whole shebang together. Take a mental screenshot of these schemas right now. This is the distilled logic you need. Anchor that 75% of 1% for original shares and debt instruments. For Realty DST, always choose the highest between consideration and fair market value. Remember that a massive 50% surcharge requires willful neglect or hitting that 30% fraud threshold. And for micro taxpayers, just apply the relief rules, a 10% surcharge and 50% off interest. This is the structural logic that's going to survive in your brain for the next 3 years.
So let me leave you with this one final thought. If you mix up deficiency and delinquency on the LEPCPA, are you ready to pay the ultimate penalty of losing your license? Master the precise language and logic of the tax code today. Move away from that rote memorization, really understand the why, and you will absolutely dominate this section of the boards when your time comes. Thanks so much for joining me on this explainer. Keep studying smart, and we'll see you on the next one.